when it comes to looking at ESG and what businesses need to be doing when it comes to ESG, I thought what might be helpful for those attending the webinar this morning is to provide my insight on the market trends that we see in this space. So in my role as head of ESG in the product and go-to-market team at Dun Bradstreet, I'm responsible for understanding what's going on in the market and what ESG data products and solutions we can be building to best support our client base. And so I thought I'd share some of that insight with you. It's something that I hear a lot when it comes to ESG, and especially in the current political climate, especially certain trends occurring in certain markets, such as the US, is ESG no more, or do businesses still care about ESG, or is it becoming a little bit of a dirty word? What I have been seeing, however, in clients' behavioral trends is that actually it might not be as buzzy and as hyped as it has been in the past, but actually it's moving more towards a BAU need for clients in this space. And in particular, there was a study done by EcoVadis on US companies specifically, and when surveyed earlier this year, 87% of those companies have said that they've either maintained or increased their investment in business sustainability since the beginning of 2025. So it's certainly not going anywhere, and the majority of businesses are continuing to invest within it. But what was interesting in that report was that a third of those businesses said, whilst they are doing that, they are reducing the PR around how much they're doing within ESG and sustainability. So they're still doing it, but they're maybe not shouting as loudly about it, whilst certain political climates are a bit more volatile. But similarly, another study by Economist Impact, over 62% of those respondents surveyed said that sustainability in supply chains specifically remains at least as important as it was a year ago. This is also reflected in what trends we're seeing within the banks and the financial institution space. So in Europe in particular, and the UKI, so the Prudential Regulatory Authority for UK banks and the European Banking Authority, they're increasing their requirements when it comes to integrating ESG into risk management and reporting. And so we're really seeing that used as a lever to have a trickle-down effect on how you can influence business behaviours when it comes to improving sustainability performance. And we'll come on to that in a little bit. But also a key trend that we're seeing now from client asks is really evolving beyond net zero. So of course, net zero is still a priority for the majority of us, and how to decarbonize supply chains is a key part of that. But more and more we're seeing demand for other topics, such as deforestation, water stress, biodiversity, forced labour and conflict minerals, and also physical climate risk. Many of these are influenced by regulations across Europe, such as the EU deforestation regulation. But in general, businesses really see the benefit in managing these risks, not only to their business, but what impact their business is having. So talking a bit more about the banks and what trends we're seeing there, this infographic really puts it into perspective. So these graphs are from the European Central Bank, and the top graph is from 2022 and the second graph is from the end of 2024. And essentially the red and yellow are where there was no practices in place or only basic practices in place for banks to have climate-related and environmental risk management practices in place. So even in 2022, a large proportion of them, almost 80% of them, only had either basic or no practices in place. But we've seen a really significant shift when we look at the end of 2024, where all of those green and dark green they've really moved on to emerging practices or leading practices for some of those climate risk and sustainability exposures. So they're really investing in and driving how they can manage these risks within their lending portfolios and their investment portfolios. And so this is going to be something we see more and more when it comes to businesses requiring funding or investment. Banks are asking for this kind of information from those businesses and often using it as a criteria when it comes to sustainability linked lending or green finance. So whilst we are moving in a good direction and making lots of progress, we certainly are seeing challenges within this space. So I couldn't really talk about ESG currently without mentioning the EU omnibus on ESG regulations within Europe. So if anybody on the call isn't familiar with the EU omnibus, it's basically a collection of regulations that the EU have initiated, such as the Corporate Sustainability Due Diligence Directive, the Corporate Sustainability Reporting Directive, and also CBAM, the Carbon Border Adjustment Mechanism. And these set of regulations have had a lot of pushback across the EU, which has led to them needing to be revised. And actually, even in the last few weeks, the latest proposal for what's included in those regulations has been rejected, and so they're needing to be revised yet again. So the challenge with these regulations is the intention behind them are fantastic. It really is to ensure that businesses, large corporates in particular, are doing the right levels of due diligence on their whole supply chain. The challenge and the pushback is coming from how realistic is it for businesses to be able to achieve this, especially when the initial proposals for these regulations were not just really large corporates, but also some of the mid-sized firms across Europe as well. And in reality, that is still very difficult for businesses to have the right level of information and data on their supply chain to be able to comply with these kind of regulations. So I'm sure we'll get to a state where we can all agree with the requirements of them and how businesses can comply and how businesses such as D&B can support with the compliance of those regulations. But at the moment, it's agreeing what exactly that should look like so that we can progress towards the EU sustainability goals. Sort of in a similar vein as well, we have the Net Zero Banking Alliance, which is a collection of banks who were endeavouring to work together to agree on how they could share and learn how they were progressing towards net zero. So earlier this year, this has actually paused all activities and now been disbanded. And again, this is due to lack of structure on banks on how they all want to approach it in the same way. There's not a sufficient top-down view of how banks and what banks should be doing in order to progress to net zero, but also after a few larger banks pulled out due to concerns around competition, the value in them not all being involved meant that this has now all been paused. So we're still seeing challenges within the market for sure, both across EU-wide corporates, but also within the banking space as to how we unify and collectively agree what should be put in place so that we can progress towards net zero and our other sustainability goals. But still staying on the topic of large businesses being able to influence behaviours within their supply chain, we're really seeing an emergence in utilising supply chain finance in particular to improve sustainability within supply chains. So ASDA earlier this year announced their latest in terms of sustainable financing for their supply chains with Lloyds Bank. They had been doing it previously, but this is really an evolution on from where they were of if their suppliers are providing the right level of information and are progressing in sustainability topics, then they get access to preferential supply chain financing. And Tesco were actually one of the first UK retailers to do that back in 2021. So it really is the power of businesses to influence their suppliers. And similarly, H&M Group, they have been doing a lot on collaborative financing solutions, again, of how they can influence the behaviours and make sure that their suppliers are doing the right thing. Which similarly to CSDDD, it's not just about not working with suppliers that aren't meeting certain criteria, it's how can you support them in doing so and changing those behaviours. Then within ESG and general global volatility within the supply chain space, we've already heard a few topics from Sean. Less than 8% of businesses currently believe they have complete control over their supply chain risks. And this really isn't surprising. Everybody's in the same boat when it comes to how complex supply chains are and how much data is needed to be able to make the right decisions. It's a really, really challenging thing to do and to get right. And furthermore, 77% of businesses are not confident they will remain resilient to emerging risks over the next 10 years. So again, they really want to focus on how they can become anti-fragile and put the right practices in place. Supply chain losses is a really key risk that many businesses call out. So 63% say they expect higher, they report they expect higher losses than expected within their supply chains. And the other trend that we're seeing from our clients is that ESG is, like I said before, becoming more and more BAU, but how it sits alongside all of the other risks that they're currently trying to manage within their supply chain, whether it be geopolitical, cybersecurity, inflation and cost pressures. It really is a big task now for businesses to be understanding their supply chains better and bringing in the right level of good quality data so that they can understand how they can manage that better. Furthermore, a study by CDP, the Carbon Disclosure Project, the projected cost of environmental risks in supply chains is expected to be $120 billion by 2026. Scary numbers. And actually by mid-century, climate disruption to global supply chains could lead up to 25 trillion in net losses. These risks due to climate events is just becoming more and more prevalent. In fact, a $1 billion climate event now occurs every 3 weeks, whereas 40 years ago, one of those events occurred only every 4 months. So these really are becoming a really significant risk to supply chains and can no longer be ignored.